Hey everyone, this is Al Stockwell. I'm the Life Marketing Director here with Simplicity Life in Des Moines. Lucky to be joined by with Elena Castor. She's one of our partner groups that focuses heavily on the asset-based long-term care products out there. There's quite a bit of different products out there. This is I think it's our fourth in our series of asset-based long-term care webinars. We've done different things about the different products, applications, how to use them, when to use them, all this. Now, today we're going to talk about the underwriting side of things. So from a traditional life insurance perspective or a traditional long-term care perspective, this differs a little bit, but there are some similarities. With that, I'm going to hand it over to Elena, and we appreciate it. And if in the future, if you want to see the other videos, just let us know. We've got those other ones saved that we've done in the past as well. So we're glad to share those with you as needed. So appreciate it. Thanks, Elena.
Thank you. Thanks for having me here, and I appreciate everyone's time. So I'm going to go ahead and get started. Our last session, I believe we covered a big focus on sales strategies and tax advantage play with Pension Protection Act strategies and whatnot. But today, very different conversation as we're going to talk about the importance of underwriting. Now, to me, this can be very important to you as an advisor, but also for your clients when it comes to meeting long-term care planning objectives. So I'm going to get started by covering some key differences in these plans, because we have both the life component asset-based plans and the annuities. Then I'm going to move into some case studies for you. And I want to show you twofold how, by the end of this conversation, how one extra step in the process can mean all the difference of placing the sale versus not placing the sale. And I'm also going to be highlighting along the way how we can maximize, leverage for clients by using a particular type of plan, the asset-based annuity specifically. So let's get started and look at some of those nuances. Just to give you an idea, we again have the life component asset-based plans. You're probably more familiar with these: Lincoln's MoneyGuard, Nationwide Care Matters, Securing with Secure Care, and One America and their Asset Care Plan. On the other side, we have the annuity-based plans by Global Atlantic and One America. And I say annuity plans, these are qualified long-term care asset-based annuities. So not your everyday typical annuity. They don't perform like a regular annuity. They're very different because they're qualified LTC contracts. So simplified underwriting here for both, but there are a couple differences here that I want to point out. On the life component plans, underwriters are looking at mortality and morbidity. So again, simplified, no parameds, no blood work, but they could look at medical records. Our only outlier here is One America. Most carriers will issue as applied for up to 4 tables. One America goes up to 8 tables. So they will rate. They still have a COVID guideline in place, and that is anyone 70 and up must be standard or better. We saw all these different COVID guidelines come out, almost 3 years ago, but that's one of the remaining ones. So just keep that in mind. If you are positioning this particular product for 70 and above, they have to be standard or better. Now, on the annuity side, they're just looking at morbidity. They're not looking at mortality. So that complicated diabetes case that potentially would not, if they have A1C levels off the chart, they're not going to be up to 4 tables. There would be a decline on the life component plan. You want to be looking at the asset-based annuity. They will take that case with A1C levels above the normal guidelines. So one of the things that I see day to day, and not so much, it doesn't happen a lot, but when it does, it's a surprise. That surprise decline, that surprise rating or postponement from a carrier, and that leads to unhappy clients. And unhappy clients leads to unhappy advisors. So that's where I come in. I see that side of it. So, I always push and I always talk about the importance of pre-qualifying clients. It's something that you can do that's very simple. Why would you want to pre-qualify your client if it's simplified underwriting, right? Well, there are reasons. But one of the easiest way to pre-qualify your clients, before I get into the significance of what it means for you and your client, I want to just make you understand, few pieces of information actually 5. If I get 5 pieces of information of someone's medical history, I can get the green light with the carrier. And I'm talking basics, their age, their height and weight, their diagnosed condition with a date, a list of their medications, and if they're under any treatment. And I can follow up later with an email and get these to you. But that information, getting that upfront can mean all the difference, right? And it takes maybe 3 minutes to get it from the client file. It's probably already in the client file. So this isn't something you have to do a lot of work for. By doing the pre-work, will save you an hour to 2 hours on the back end as if you didn't pre-qualify your client. And here's the impact that we see. Without pre-qualification comes that surprise postponement, rating, that decline. What advisors don't realize is that if you do get one of these, rating or a decline, you kind of limit your product availability when you're looking for the next best option. One of our most competitive carriers on the asset-based annuities is not available. They have a 12-month wait. If you're coming from a postponement, rating, or decline, you've got to wait 1 year before you can apply with them. So to me, that's a significant impact on what your next best option is going to be for your client. Now, when we do pre-qualify, we really narrow down a lot of work. Out of, say, 5 carriers, maybe only 2 or 3 are going to give us the green light. You're now narrowing down the workload in terms of putting your presentation together. You're going to have very specific recommendations for the client. Once you get into underwriting, you're going to see faster and efficient underwriting. And by the end of the day, you could actually improve your policy placement ratios by getting your cases paid. So that's the positive, right? Again, 3 minutes of your day to get some forefront information on your client, and we can get the green light same day with underwriters and get that pre-qualification started for you. So I want to jump into some case studies here for you and just kind of show you what it looks like with actual cases. So the first one up was a COVID decline, and we had to play defense here. And this was for a 70+ couple, fell under that COVID guideline with One America. The husband was 72 years old, the wife 68. She didn't fall under that standard or better guideline, but he did. Advisor thought he had, the green light. They didn't bring this case to my attention, but he just assumed he had the green light because client was already over COVID, right? Tested negative. It was 60 to 90 days out. They thought everything was fine. Well, surprise, it was not, because the client was still under the doctor's care. So when you've got a condition, lingering symptoms from COVID led to a decline. They were concerned about his follow-up care and those conditions that were still lingering. So he was a decline. Now, when One America declines a case, they will tell you if your client's eligible for their next best option, which is the annuity option. So in this case, the underwriter did approve the client for their index annuity care. Now, let's look at these benefits here. The client wanted the unlimited plan, $4,500 a month for lifetime. They paid $175,000 single premium for that unlimited benefit. The only option we could come back with was with the One America offer for their annuity, and that was the index care. What you don't see here is that we eliminated a more competitive product with one of our other annuity-based carriers, and that was Global Atlantic. So they're already off the table because of the 12-month wait. So the client's next best option was this, and it turned out not to be a bad option. They ended up with $44,748 as their monthly benefit, above what they had initially applied for, but the trade-off was here. They got a 90-month benefit, not a lifetime benefit, right? So kind of a big trade-off, but again, their next best option because we didn't have additional options to show them past this. Now, with that annuity, one of the other trade-offs is technically you don't have a death benefit. And at first that was a concern, but at the end of the day, when the advisor explained, look, whether you live, you can use the benefits, walk away, you have a guaranteed cash surrender value. And in this case, you have more value than what you did in the life component plan. If they suddenly passed away, you have that death benefit that would pay out on the life component plan. But on the annuity, it says 0. However, your cash surrender value becomes that death benefit. So that live, quit, or die mantra, that asset is not lost. It still remains, even on the asset-based annuities. You can have that conversation with your clients. So that's the COVID decline. We were limited on the options, but advisor was still able to place the annuity. Now let's look at something different here. This was a single male, 77 years old. He had 150,000 single premium to use, and he was pre-qualified. Now, the advisor on this case did not know anything about the asset-based annuities, was only familiar with the plans that he got the green light from here, Asset Care and MoneyGuard. Now, at the time, MoneyGuard wasn't pricing very competitively. That's changed since this case has happened, but the leading carrier here, for all the right reasons in terms of maximizing the client's benefits, from death benefit to the long-term care pool, that monthly benefit being $6,000 a month. This is what the advisor liked. We then introduced, because we had the green light from all our carriers, well, 3, you'll see here. We got to quote the Annuity Care 2 plan with One America, the Index Annuity with One America, and Global Atlantic's 4Care. Now, this client was concerned about benefits. He was already 77 years old, right? So his concern, again, was going on claim in the next few years. And statistically, he was actually very close, because the average claim years is 80 through 84. So his big focus here was monthly benefit. Now, Asset Care was close, $6,018 a month over a 75-month benefit period. We've got a decent cash surrender value here, death benefit 150. Everyone else comes, in between there, right? A little bit less duration. Now, if we just go to the bottom here to the 4Care annuity, you'll see that the total pool is right in there with the Asset Care plan, which is what the advisor was comfortable with. The monthly benefit was about $250 more monthly. Advisor client liked that. 72-month. Cash surrender value, $150,000. Again, live, quit, or die. This asset would not be lost if this client suddenly passed away. That cash surrender becomes the death benefit. So pretty good leverage, high liquidity. This $150,000, depending on the age and the premium for this product, you can have that 100% liquidity from day one. Not always, but in a lot of cases. If you're using inflation, it'll be lower. So again, when it comes to maximizing leverage, particularly for this demographic, you want to be looking at the asset-based annuities. You have less underwriting, so I call them ultra simplified underwriting. Underwriting is very quick, and at the end of the day, in this example, the pre-qualification process proved to be very helpful here, because we basically opened the door to look at all these products, as opposed to the previous case study where we had one product selection to choose from. So keep that in mind, because it does make a difference when you're pre-qualifying versus not pre-qualifying. I'm going to stop talking here for a minute, because I kind of covered a lot of information. Is there any questions or comments, Al, or from anyone that I can address?
I do not see anything. I don't see any hands, unless Sarah listening and sees anything, any questions that we might have at this point in time.
Nope, looks good.
Okay,
Good deal.
thanks.
So that's pretty much it. It's just, the message today really is just to, again, talk about the significance of pre-qualifying clients and what that means in terms of placement, policy placement, and getting clients through underwriting. One of the things that might be worth mentioning is that interest rates have been down for so long. They're now coming back slowly, but they are coming back, and I've seen increases consistently this year with our asset-based long-term care annuity carriers. So these products are looking more and more competitive and attractive for clients, say 65 and up. Sometimes I'm looking younger than 65 if we have medical history. It just depends, but they are looking more attractive. You could say starting as young as 60, but typically 65 and up. you want to be looking at these for leverage. Does that
I
make
am
sense?
noticing,
There was a
Elena,
question, well, maybe Sarah, you're gonna, but Alan had asked, he asked an indemnity versus reimbursement. I've got a good little piece here. I think Elena, you may have put this together, but it breaks down the differences between the multiple products out there and who does reimbursement, who does indemnity. So Alan, I've got your email. I'll send you something like that. If anybody has or wants to see that, just let me know as well. It's a good little piece. Kind of talks about a lot of different things, but it does address those specifically.
Right. Basically, there's pros and cons to both. I'd say the biggest potential con for the indemnity would be if clients are over the per diem limit. So let's say the per diem limit's 400 a day. If they get paid benefits above that, they need to save receipts on that indemnity policy because they'll have to prove that they need to justify those expenses to not pay any taxes. Reimbursement, you don't have that per diem rule guideline. It only applies to indemnity plans. But the cash is king theory about indemnity, is true, but it may have some risk on the back end, including misuse of funds, depending who the party is involved in where those funds are going to. Reimbursement, when it comes to international benefits, you may be limited to facility care only, right? So there's kind of a restriction there because these plans do provide international benefits, but more restrictive on the reimbursement model. The reimbursement model to me is an efficient model. So if somebody has a 6-year plan, and let's say the monthly benefit's 10,000, they're using 8,000 for the first 2-3 years of claim, that unused benefit, that's theirs. That stays in their account. It's going to be used for future claims. So a 6-year policy could actually last 8 years. It just depends how much of the benefit they're using up. Indemnity pays that full monthly check, and now you can exhaust that policy quicker. So you can look at that as a con, any way you like, but there's always pros and cons to both those approaches. The piece that Al's going to send you, I would advise send it to everyone. Al, it's a great piece. It just breaks it down. And at the bottom of that piece, you'll see a quick list of the carriers, which ones are earmarked for indemnity versus reimbursement.
One thing I want to bring up, Elena, is that if you get a decline on one of these asset-based products, and it's because of the morbidity side of things, that's the LTC side of things, but the mortality side, they're healthy, but that kicks them out of the asset base. Let us know, or let me know, because those are things that there's some traditional life products with chronic illness riders that do not limit the chronic illness use down the road. So even if you get someone who even rated from a mortality standpoint, they can access that death benefit through their chronic illness rider. So there's a couple carriers that work well for that. So a little bit different product, but again, a good alternative if you run into that unfortunate decline. Right.
And we have pre-qualification forms as well. You don't have to put together a full email if you want your clients to fill out a form to pre-qualify. Both of our asset-based annuity carriers, they have those forms available, and I can shoot those over to you if you'd like to take a look at them. Yeah.
One other question. There was can the owner be other than the insured or the annuitant?
Say that again.
Can the owner be someone other than the insured or the annuitant? Can you have a spouse be the owner or something like that? I don't know if that's the question. Or
I believe so, yes. Yeah. Are you talking specifically on the annuity?
I think it's for either or. I think the question was either or, but I'm not aware of any restrictions on that. So that we can look at that specifically. If you got a case that specifically has an issue with an ownership question, we can check that out. That's relatively easy to do.
Okay. I've got a pretty good document on ownership, and it kind of covers trust ownership, covers all the things. It's probably in there, but yeah. I can send you that. Okay. Just make a note. All right. Did we get another question in the chat box, or was that it?
No, that was it. And you mentioned pricing a little bit, Elena. I know that's one thing I see a lot is a lot of, I probably in the last maybe month or two, I've gotten emails from 3 or 4 of the different carriers regarding different pricing and stuff like that. So
right.
If you looked at it,
several changes.
It seems like
in the past year.
Yeah, I don't know if it's well, who knows? But the asset-based long-term care stuff seems to be a little more susceptible to pricing changes, and
Right.
maybe that's just.
And it's been a good past 12 months because we've seen the reverse. We've seen pricing reductions by Lincoln, MoneyGuard, Nationwide Care Matters just this week announced a pricing reduction. One America announced a pricing reduction. And we've also seen product revamp by Securian. We saw some great features added, a very good feature added on the Lincoln MoneyGuard product. They enhanced another one called the FlexCare Cash. So for that indemnity versus reimbursement conversation, kind of pulls us back into that because Lincoln has always been a reimbursement model plan, but they provide indemnity benefits. And that's kind of been a shift that we've seen happen in the past few years with that particular carrier. So clients can get informal care benefits on a reimbursement model plan with a Lincoln MoneyGuard. Up to 50% of the monthly benefit can be used for informal care. Now, when they first came out with this, it had a restriction. You had to be on care for reimbursable services. So somebody had to be coming out to the home from a home health care agency if they were getting care in the home. Now it doesn't matter. They'll pay up to 50% of the monthly benefit and you can be on claim just for informal care. No receipts asked. So very powerful move that they made there in competing in that indemnity space, right? Because they just made their contract that much more flexible to get to the benefits.
Maybe one more question here. No, maybe not. Maybe that was it. So, so good information. I would just add that if you're the question with these products, you have to have your long-term care certification. It's always specific to your state. So I get questions a lot. You know, we do business in all 50 states for the most part, and they'll always ask me, what do I need to do for my long-term care? Long-term care is very specific to your state. It's not like your life and health and stuff like that, where it's more generic. Every state has a little bit different take on it. Some, they don't need any extra training. Some of you need to do a 4-hour, some of it's 8-hour, and it's all over the board.
8-hour, 4-hour, and 2-hour for CE, and it does vary by state. Like Colorado is a big state for hours. I think there's like a 16-hour course initially, then 8-hour every 2 years. That's probably, the more aggressive type of CE involved in the initial training. Yeah, and then your life and health license, obviously, and that's it.
Yeah, and then I would also, and final, maybe just to wrap it up, if you're not talking long-term care in some form or fashion with your clients, and you're looking to do more business, specifically on the life side, you want to add, a lot of times that long-term care conversation is going to be the catalyst to getting more interest in those clients. They may be at that age where they're not necessarily a candidate for life insurance or an asset-based product. They don't need the death benefit. The spouse is going to be fine. Kids are grown. They're not replacing their income. They're not paying off debts, mortgage, all that type of stuff. So they're like, well, I don't need life insurance. Well, introducing life insurance with a long-term care focus. Now they know, because a lot of people don't like to buy the standalone long-term care. They want the dual benefits. That's either from a life plan with long-term care or these asset-based products. You're getting the benefit one way or the other. So I'd say right now on a permanent side of our sales, I'd say probably 80% of all of our permanent product sales right now have some emphasis, if not 100% emphasis on the long-term care benefit. So absolutely hit them up with that long-term care side of things. If you're not familiar with all the riders and different things, just let me know, because there's a ton of them out there, lots of good sales ideas from that perspective.
That's a great point that you made, Al, on the percentage of sales that are including the long-term care riders. So the conversations are happening, and more so than ever before with the pandemic. This is an easier conversation to ease into with clients. From my end, because I work with our member firms and the advisors funnel up through our firms. From my end, I've seen a lot of proactive outreach by clients all throughout the pandemic. So very simple to start that conversation, whether it's due diligence on an annual review. Maybe it's, maybe you're in one of the states that are looking at the long-term care tax mandate that we saw happen in Washington. A lot of states are looking at that. Easy conversation starter. And a lot of people have experience with this now, unfortunately, of seeing their loved ones get really sick and people passing away for the past 3 years. It's coming up a lot more. So ease of conversation, and now's the time to have the conversation if you're not talking about long-term care.
Yep, absolutely. Well, appreciate it, Elena. Thanks for the great stuff as always. There was a question again. I'll reemphasize. We had talked about the previous sessions. I'll get with Sarah here in my office about see if we can't package those all up into one quick and easy email or some form of that. Something technologically that's over my head, but getting them all out to you at once so you have access to all the different webinars that Elena's helped us with. So Elena, we appreciate it very much. Always a great resource for us.
You're welcome.
Thank you.
Thanks, everyone.
Yeah, thanks for everybody for listening in. And as always, give us a shout, email, whatever you need to do, get a hold of us. We're always here. Appreciate it. Thank you.
Bye.